What is up, ladies and gentlemen? Today we're going to be talking about the holy grail of investing. We're going to be talking about passive income or a second income. We're talking about how to take the money you have and turn it into a steady flow of money for yourself and your family for the rest of your life. In this video, we're going to break down a number of ways you can do this and my thoughts on each type, pros and cons. So stay tuned and welcome back to Casual Cash. So you might be like me in that your main source of income is from your salary or a job that you have to work. And for some of us, we don't especially enjoy our job. And for others, maybe you do. But either way, if you're looking to become financially independent, retire early, or even just earn a couple extra bucks so that you can upgrade your car, improve your children's future, or even take a holiday away every now and then with the people you love, then a great way to do that is to start earning and building a second passive income. And the idea here is that if you have extra money from your salary that you can invest each month, then after every month you invest, you'll be earning more than you were the month before and improving your life, and over time, who knows how high that can go. Okay, so I think we can all agree that the idea of a second income that we don't have to do anything for and grows over time sounds great. But how do we go about it? What are the options and what is the best option for you? So because this is Casual Cash, we're going to look at 5 main places you can invest your money to earn a passive second income, each one a bit more interesting. So let's get to it. The first way you can earn a second passive income is interest. Now, I know that sounds simple, and yes it is, and also it isn't. It is simple in all the ways that you want it to be. It is totally passive income with, let's say, 99.9% safety for your money. But what I think is important to keep in mind right now is that interest rates are rising. Typically, rising interest rates means a slower stock market, and banks both charge and give higher rates to cash. So I remember in COVID when they lowered interest rates, my Investec account was at 3.75% interest, and now it is at 5.75% interest, so not a bad income. Now, for me, I always think you should have a portion of your savings or investments in cash, because you never know what may happen in the markets and you may need cash quickly at some point without having to sell anything. So if you're saving a portion of your funds in cash, it pays, literally, to find the best interest rate that you can for your needs. And that will depend. Some SA retail savings bonds offer up to 11%, but only on a 5-year fixed term with no access to the funds. Then there is Time Bank with immediate access to your cash with 7% interest. So find whichever is best for you, but especially now with raising interest rates, interest is a great and safe source to earn a second income, and with compound interest, the amount you earn will go up every month. Now let's chat about unit trusts. Simply speaking, a unit trust is where multiple people's money is pooled together to make investments collectively, and those investments are managed by a fund manager. The fund manager is usually your Coronations or Allen Greys. There are many different types, but here specifically we will be looking at income funds. Now, as the name suggests, these are funds with the purpose of earning you an income. Usually these unit trusts will invest in a range of products such as equities, cash, government bonds, and property. So your money is pooled with everyone else's into this fund, and the profits are split between the investors as well as yourself. On Easy Equities, there is a range of these you can look through, but I'm going to speak specifically on the ones I have from experience. I invested 20,000 Rand in the Coronation Strategic Income and 25,000 Rand in the Prescient Income Provider. First of all, take a look at the unit trust prices. These are specifically built to have very little volatility and typically don't trend to more than a couple percent a year. So as far as active investments go, they are usually lower risk. Now, as for the Coronation Fund, it pays between 5 to 6% income per year, and this is paid to you every 3 months. But I know a lot of people are quite fond of the Prescient Income Fund because it pays your income every single month, exactly like a second salary that you can build up. So before we get into some complex investments, if you're looking for a simple and secure way to earn a second income, a good method is to put away money into a high interest bearing account and an income focused unit trust. In theory, these will pay you every month or 3 months or whatever you choose, and as you continue to add to it, this should increase your second income as time goes on, and if you reinvest those funds, it will grow even faster. But every time you add to it, your second income should go up along with it, and your money is pretty safe. Okay, next we're going to touch on property before going into shares and ETFs, and I think I have some very interesting views here. So here are the 3 main ways to invest in property and my pros and cons to each. The first is physically, where you buy an apartment, house, or commercial property and rent it out. The second are collective investment schemes like Easy Properties, and the last is to invest in listed property funds. First, if you're buying a physical property, in my opinion, the biggest problem is risk of income. For most people like myself, you might only have the means to buy one investment property at a time, maybe an apartment to rent out. The risk is whether you can rent it out, but also the risk of tenants not paying. Here in South Africa, our legislation has something called the PI Act, or Prevention of Illegal Eviction Act. To put it very simply, if your tenant stops paying you, there is a long, very difficult and expensive process to evict them. It can be between 3 to 6 months, and you will probably have a bond to pay, not to mention electricity, water, assessment rates, and if the tenant isn't paying, there are legal costs and maybe damage to the property, and it can end up costing you quite a bit. That is the risk of physical property. In my view, if you have 1 or 2, for example, there's a lot of risk in a small basket. Next are the collective investment schemes like Easy Properties, and I actually like this method of investing. It allows you to invest with a group of other people in a property with many units, so your risk is very well diversified in something like this. My only issue right now is that with Easy Properties you can't sell your share at the moment, so it means you don't have access to your capital very easily if you want it. Otherwise, I think it's great if you won't need that capital, and maybe they will solve that in the time to come. Lastly is where you can buy shares or equity in property investment companies, like the larger ones we know such as Growthpoint, Redefine or others. There are also ETFs we'll touch on later, but this allows you to buy shares on the JSE in the companies that have hundreds of properties and share in their income by dividends. This is also a nice option because these companies have so many properties that the risk of any one tenant not paying is evened out by the others, and most of the property companies are paying typically between 6 to 20% in dividends depending on the company. Of course, the risk you have here is the company and the stock market. If the company isn't run well, your investment could depreciate, and also if the stock market in general goes down, you can see share prices go down as well. So all of them have their pros and cons. In my view, if you're starting small, shares and ETFs are a good option, and if you have access to sell them at any time. If you don't anticipate needing that capital, you can look at something like Easy Properties, and in my view, if you're looking at buying physical property, make sure your risks are covered by either buying multiple properties or looking at something like rental income insurance to protect your rental income, although it comes at a cost. Next, we have shares. This is where you look to buy a portion of a company for a portion of their income or growth. Not all companies pay dividends, but those that do will pay you a portion of the income of that company. So we're talking Standard Bank, for example, or Tiger Brands, or Vodacom, or Woolworths, all pay you income based on their income as a company. Just keep in mind, most companies usually only pay their dividends once a year or every 6 months, but you can also get some pretty good capital gain growth as well. Then we have ETFs. Basically, an ETF is a collection of shares of companies all in one, such as a mining ETF or an ETF of the top 40 JSE shares, or the top companies of the fourth industrial revolution, or a collection of property companies. Similarly, with normal shares, you get a portion of the income of those companies in the ETF, and some of these, like the property ETFs, can pay 4 times a year. The last option is quite an interesting one, which is collective farming investments, where a company like Fed Group or Livestock Wealth acts as a broker between you and the farmer, and your money is used to farm things like plants, livestock, beehives, or even solar panels. Then when those products being farmed start to bring in income, you get a share of that income. An example is buying a solar panel from Fed Group and generating income from the power it produces, or buying a cow from Livestock Wealth and sharing in the profit when that cow is sold at market. And the returns have, depending on the product, typically been between 10 to 14%. I have done a few investments with Livestock Wealth and gotten 10% per year return on investment, but I'll be honest, their customer service wasn't great at the time, and I've not invested with Fed Group as of yet. And guys, that is it for today's video and the different ways that you can invest your salary to create a second income for yourself. If you enjoyed it, please leave a like on the video. If you know of any others, let me know. And if you have questions, I'll try to answer them all in the comments. There is a lot to unpack and you should always research these yourself, but we have also reviewed a few of these on the channel already and will do more in the time to come. So if you haven't already, feel free to subscribe for more. But until then, I will see you again next time on Casual Cash. Cheers.